Hello everybody and welcome back. Max here with Smart People Finance, the place where you can learn how smart people make their money, how they use it and invest it to grow their wealth day by day. No get-rich-quick scheme here, but only the strategies that really work and that can make you rich slowly and steadily. In this video, I'm gonna show you a better way to invest in stocks using options. I'll tell you what a cash secured put is, the pros and cons of using it, and why you should learn trading them today. Be sure to watch the video till the end, as I'm gonna show you how to set up a cash secured put from my real account, and you will be able to copy one of my trades if you like. So without further ado, let's jump into it, but first please subscribe to the channel, smash that like button and hit the bell so not to lose any future videos from me and be always updated. This is so crucial for the YouTube algorithm, so don't forget to do it. This will help me grow the channel and help more people like you. But now, without further ado, let's go into it. As usual, let's start from the website smartpeoplefinance.com, and I'm gonna read the post for you, highlighting the most important points. What is a cash secured put? In this post, I want to introduce you a better way to trade stocks. I'm going to answer the question, what is a cash secured put, and much more. I'll show you a better and more efficient way to build your stock portfolio. My suggestion is use this strategy to grow your portfolio, as it's more capital efficient and even clever to do this way instead of buying directly the stocks. Also, a great investor like Warren Buffett used this strategy and has used this strategy several times. So my question is, why shouldn't you? But before going straight, speaking of the cash secured put, let me recall what options are for people who are not keen on this instrument. What is an option? Basically, an option is a contract where the buyer has the right, but not the obligation, to buy or sell the underlying asset, which usually is a stock, at a specific price on or before a certain date. What you are doing basically is buying a choice. When you buy an option, you're buying a choice, a possibility. The specific price at which you can buy the underlying asset is called the strike price. The date by which you can exercise your right is called the expiration date. The expiration date varies from weeks to years, but generally they have a maximum duration of 2 years. What happens if you don't exercise your right by that day? Well, the option expires worthless. The most important point to understand is that each option contract controls 100 shares of the underlying asset. So, when you buy an option, you have to multiply its value by 100. Let me show you this example of how an option contract may appear. As you can see here, this is a Facebook call option with a strike price of $335 expiring on the 15th of June 2021. Now, let's say that this option contract has a cost of $1.5. If I want to buy just one contract, I have to pay $150 because I have to multiply the cost of the option, $1.5, by 100. Now, let's go on and let's talk about call and put. When you buy a call option, you have the right to buy the asset at the specific strike price chosen. If you buy a put option, you have the right to sell the stock at the strike price. Okay? So you buy a call option and you have the right to buy the asset, or you buy a put option to have the right to sell the stock at the strike price. When you buy a call option, what you want is the stock price to increase in value, as you can buy it at a lower price, actually at the strike price you choose. Vice versa, if you are buying a put option, you want the stock price to decrease, as you can sell it at a higher price. So anytime you are bullish on a stock, you buy a call option. When you are bearish on the stock, you buy a put option. Let's see now another important point. Buy or sell. As for stocks that you can short, also options can be sold. This time, when you sell the option, you receive a credit which is called premium, as now you are the seller. If you are selling an option, everything now is reversed. When you are bullish, you sell a put option. If you are bearish, you sell a call option. So remember, this is the opposite. In fact, when you were buying the option, if you were bullish, you would have bought a call option. Instead, if you were bearish, you would have bought a put option. This time, as you are selling, if you are bullish, you sell a put option. If you're bearish, you sell a call option. Okay? And the most important point here is that now that you are selling the option, now you have the obligation of buying or selling the underlying asset at the strike price on or before the expiration date. I hope that everything is clear now. If you want to go deeper into this topic and learn the basic of options, I strongly recommend watching my complete free course, Option Trading Crash Course. You can have on the upper right corner the link to this video course. It will help you understand deeply all we are going to talk about in this post. Now, let's see the cash secured put strategy. So let's get straight to the point. What I want to show you is what and how you set up a cash secured put strategy. But first of all, let me say that this is one of the strategies that I approve to use, even if it's not one of my favorite. Personally, I don't like to own stocks, but I prefer to trade directly options. By the way, this strategy, the cash secured put strategy, is one of the strategies that I approve to use. There are some strategies that are even more efficient than this one, and by learning them, you can easily make a 20-50% per year with a very low and controlled risk. Of course, you must know only the strategies that really work and how to use them the right way. That's why I created the selling option, the cash machine course, where I teach you exactly what I do to be a consistently profitable trader. You can have a look at my real results, my real account, clicking on the link here if you are watching on my website, or you can find down in the description a link to the video where I'm going to show you my real trades, my real results. But that being said, if you still prefer to trade and own stocks, I highly recommend using the cash secured put strategy instead of directly buying the stock, and I'm going to show you why. Let's see the scenario for a cash secured put strategy. For example, we are interested in Coca-Cola stock. At the moment, Coca-Cola is trading around $55, and you think it's a little bit overvalued, and so as a stock trader you prefer to wait to buy them. You would feel good owning Coca-Cola, let's say at $45, because you made your analysis and you think that $45 is the fair value for Coca-Cola. Now, as you are a stock trader, you would just wait to see Coca-Cola reach your target price of $45 before buying it, but this could take time, maybe months, or who knows, maybe Coca-Cola will never hit that value anymore. So you are basically losing the opportunity to buy Coca-Cola just because you think that it's overvalued. So you're waiting for a correction that maybe it may never happen. What you can do instead, and what I suggest to do, and this is what even Warren Buffett do, is start selling put options on Coca-Cola stock with a strike price of $45, expiring in 30 days. Remember that the strike price that you choose, this example, the $45, is the price at which you would like to buy Coca-Cola. So, selling the option with the strike price of $45 expiring in 30 days, you collect a premium. For example, this premium might be 9 cents. But remember, as you are selling a contract, and an option contract controls 100 shares, you have to multiply this 9 cents by 100, and it's $90. So you are collecting $90 selling one option on Coca-Cola with the strike price of $45. Now let's see some scenario. What can happen? Now that you have sold the put option, you have the obligation to buy the stock at the strike price by the expiration day if the buyer exercises his or her right. In the example before, you sold the put strike price of 45, meaning that if Coca-Cola drops below your strike of $45, you are obligated to buy 100 shares of Coca-Cola. This means that you must have enough liquidity in your account to buy 100 shares of Coca-Cola at a price of $45, and this is equal to $4,500. Every broker, to allow you to sell a put option on Coca-Cola with a strike price of $45, will require you to have $4,500 cash in your account, and that's why the strategy is called cash secured put. Okay, I think it's clear now. Let's see the best thing that can happen. Let's see that after 30 days, Coca-Cola still trades above your strike price of $45. In that case, the option expires worthless and you keep your premium. Your $90 remain on your account, and this is a 2% return on your capital that you made it in 30 days. Now that your option is expired, you can repeat the process and collect even more premium till the day where Coca-Cola will eventually close below your strike price, and on that day you will be assigned 100 shares of Coca-Cola at $45 as you wanted since from the beginning. The difference is that you collect more money during your wait. And if Coca-Cola never closes below the strike price, you'll continue to collect premiums month by month. And believe me, you can easily earn a 10% per year applying this strategy, which is very simple. But you can also have bad days, and the worst scenario that can happen is the following. If Coca-Cola drops well below your strike price, okay? So you have sold this put option, strike price of 45, but let's say that Coca-Cola dropped down to $30. In that case, again, you are assigned 100 shares of Coca-Cola, but this time at a price of $45. So now you have 100 shares of Coca-Cola with a cost basis of $45, which is $4,500 in total. So you are losing money on the stock because now Coca-Cola is trading at $30. But consider that you would have bought Coca-Cola at $45 in any case. So for you this is not a big deal because you would have bought that Coca-Cola at $45 in any case. But what's even better now is that this scenario happened just 2-3 months later, and in that time you collected some premium, and that premium that you collected now help you to lower the cost bias. So for example, let's say that you collected $5 per shares in 3 months. Now your cost basis is not $45, but it's $45 less all the premium that you collected since now. So if it was $5, your cost basis now is $40. So to start earning money, Coca-Cola should bounce back to $40. And from $40 up, you are only earning money. Instead, if you would have bought only the stock at 45, you still have to wait the Coca-Cola to go to up to $45 to be at break-even. You see the difference? That's very important, and that's why it's still better to apply this strategy instead of directly buying the stock. So let's see some conclusions. The strategy is relatively simple. The most important thing that you have to do is apply this strategy only on stocks that you would like to own, and choose the strike price at which you would like to buy the stock. And that's it, nothing more. In this case, if you like to own this stock, and if you sell the strike price at the price at which you would like to buy the stock, this strategy is more capital efficient, is more efficient in general than buy directly the stock. And that's it, guys. This is all I have to do on this strategy. But before going now on my real account, my real platform, and show you how to set up a cash secured put from real, let me say that there is even a better way to trade options. And in general, selling option is the best way to earn consistent money. Even the Chicago Board of Options Exchange, the CBOE, reports that selling options are one of the strategies that outperform all the others. And I can confirm this because I'm an option trader. But it has some risks and you must know them and control them. And if you just apply only the best strategy that really work, then selling options can be even less risky than trading stocks or other assets. Selling options allows you to earn consistent money all year round. Have a look at what I usually earn by trading only the best strategies, watching my real statement video where I show you my real results, if you haven't done it so far. In conclusion, I highly recommend you invest in yourself and learn the skills you need to be a profitable trader. I created the Selling Option the Cash Machine course just to teach you that. Stop wasting money and learn the skills you really need. That's it. But now guys, as promised, for all of you that stayed till the end of this video, let's jump into my real account and show you how to set up a cash secured put. Here we are, this is my real account, and this graph is showing the S&P 500 that today is going down. Let's see how much, yeah, 2%, around the 2%. It opened with a gap down and now it's still pushing further down at the lower price at the moment. I have adjusted position. I'm gonna show you. I sold a put credit spread on Boeing. I sold 5 contracts with a strike price of 175. This is a put expiring in 11 days, and I simultaneously bought 5 put, strike price 160, expiring in 11 days. You can copy this trade if you like. You can enter with a better price right now. I have a unrealized loss of $60 on this, but consider the probability of this option to expire in profit with at least $1 is 96%. So consider that I'm not soliciting you to do this, I'm just showing what I do. It's not an advice, this is just my trade and you can see and copy it if you want. By the way, let's go back and create a cash secured put. First of all, what you have to do is find a stock that you'd like to own. For this example, yeah, let's say that you like MasterCard. Let's see the graph. Okay, at the moment it's going down, you see. Let's say that you made your analysis. Maybe you think that it could go down to 355, for example. So for you owning MasterCard at $350, it's a good price. So instead of waiting for the stock to go down to this price, considering that this thing might not happen, because for example from tomorrow the price could just bounce and go towards the high again, what you can do is selling a put option with a strike price of 355 or 350. So you go on trade, you go on the table, here you have the options chain. Yeah, consider that in this case we have earnings coming in the next week, so probably it's not the best stock to do this, at least not now. I wouldn't trade the MasterCard with earnings coming up, but for this example, just to show you, I'm gonna do that. Let's choose a 30 days expiration date, for example this one on the 32 days. And we said that we'd like to sell a put of 350. So as you see, you have calls in this side and put on this side. So we see here the strike price of 350. Now you have to sell a put. So you go on the bid price. If I click on this, as you see, I'm selling one contract. So remember, in this case, as MasterCard, the strike price I choose is 350, you need to have cash $35,000 on your account to just sell this put, because selling a put with this strike price means that if MasterCard closes below 350, the strike price that you sold, you are obligated, as you are the seller now, to buy the stock at 350, even if it's going down to 340 or 335. That's why you want to sell an option at the strike price that you wouldn't mind to own the stock. So for us it was 350. As you see now, from the maximum loss, it's $35,000, which is the strike price multiplied by 100 less the credit that we are receiving. That for this option is $6.10. Again, multiplied by 100, we are collecting $610. So if I take the calculator and we do $615 divided $35,000 multiply 100, we are earning 1.7% in 30 days. Okay, so you see the power of the strategy is that if in the next 30 days price of MasterCard remains above 350, you will keep all the $610, earning 1.7% in a month. And what you can do is the next time again repeat the process and sell another put option. The worst scenario is that MasterCard price goes and drops below your strike price. Maybe it's going to 340. In that case, of course, the buyer has an advantage to sell you the stock price at 350 when it's trading at 340. So for sure he's gonna exercise his right or her right, and you are obligated to buy a MasterCard at $350. Again, in that case, now you end up owning MasterCard with a cost basis of $35,000 less the credit you have received. So if also the next month we are receiving again another 600, let's say for example another $600, now it's $1,200 we earned in the last 2 months. So our cost basis will be $35,000 less $1,200 that we collected. So it will be easier for us to go to break even if the stock price starts to increase again, instead of directly buying the stock price at 350. You see the point? That's it. Very, very easy. All you have to do is just this. Of course, if you are looking for the market leaders like MasterCard or the ones that I usually trade, you have to have a lot of cash on your account to do this, because the price of these stocks is pretty high. But you can apply the strategy even on less expensive stocks, like for example something in the range of $15 or $30 per shares, which means that you can sell a cash secured put, keeping $1,500 or $3,500 cash in your account. So you have to have a look at all the possibilities, stocks that you have, and choose yours. So that's all, guys. After this you have just to review and send the order. Like in this case, you see the credit that I'm gonna receive, it's 615. The reduced power, which is a reducing, of course mine is a margin account, so I can do this not keeping all the $35,000 on my account, because working with the margin it's riskier, especially doing this. So I would suggest to keep a cash account just to avoid to be called to put some money to cover in the case you get assigned. Okay, and that's it for my case. Now let me just clear the order. Let's see my position at the moment. My credit spread is $60 in a loss, as you see. Just to show you, it's on Boeing. let me show you. What I sold is this put credit spread. So I have this margin, as you can see, before I can have my my credit spread challenge. Only in that case, if the stock price reaches my strike price, I still have some things to do to turn my position and collect more credit. I teach all my strategies in the selling option, the cash machine course. In this course, I'm going to show you only the best strategies that really work and that can earn 20-50% per year depending on the market with a low and controlled risk. I can teach you how to manage the positions to end up with a 95% of profit trades per year. That's the average that you can have. If you're interested in this course, you can go on the link in the description, click on it, and you can still take advantage of the offer that I am giving out during this time. I hope that these cash secured strategies can help you be more capital efficient. I highly recommend you using this instead of buying directly stocks. If you like this video, please give it a thumbs up. Leave some comments below if you want to see something more on this, or let me know what other topics you will be interested in, and I'll prepare some videos to help you. Don't forget to subscribe to the channel, hit the bell so to be notified for all my future videos and be updated. I wish you a great day and see you on the next. Bye.